clients, welcome to PhillipCapital Weekly Market Watch. I'm Caroline, Analyst from Phillip Securities Research. Today, I will share with you on Global Logistic Properties GLP. GLP is a real estate developer specializing in logistic properties and has a presence in China, Japan, and Brazil, with about half of its portfolio in China. Today, we'll take a look at the outlook of the logistic property sector in China. China's economy is currently undergoing structural reforms and rebalancing. The Chinese government is planning to shift its economy from an export-driven model to a domestic consumption-driven model. In the first quarter of 2014, China's GDP growth slowed to 7.4% year-on-year, down from a growth of 7.7% year-on-year in the first quarter of 2013. Fixed assets investment grew at 17.6% year-on-year, down from 21.4% year-on-year in first quarter of 2013. Retail sales grew at 12.5%, remaining in double-digit growth. Export growth in May was up 7% compared to 0.9% in April due to recovering global demand, while imports fell 1.6% versus 0.8% rise in April, which may highlight risk to domestic consumption growth. Overall, we have a neutral outlook in China with a stabilizing economy. Though China's economy is growing at a slower pace, logistic property market remains brisk in the first quarter of 2014, with logistic supply continues to lag the demand. Most of the China warehouse inventory are obsolete, and only about 18% of the 560 million square meter China total warehouse inventory is categorized as modern logistic facilities. China warehouse stock per capita is only 1/12 of that in the US and will only reach 1/3 the size of the US in 2030. The tight supply situation is further worsened by the limited industrial land supply released by the local government. The robust demand is mainly driven by the 3PLs and e-commerce in the eastern China and relocation of MNC towards inland in the western China. In the current competitive business environment, effective supply chain management is gaining importance to improve companies' earnings. In China, transportation cost is about 18% of operating costs, much higher than those in US and Japan. Most companies are shifting from having their own logistic networks and distribution centers to outsourcing their logistic needs to third-party logistics for better management and economies of scale. Also, the rising costs at coastal area triggered inland migration, leading to strong demand for logistics services, thus the need for more logistics space. The rapid growth of e-commerce is another key driver for the growth of logistics space demand. China internet user has reached 641 million in 2013 and has overtaken US to be the country that generates the highest online shopping sales of USD 300 billion in the year 2013. Yet China internet penetration rate in 2013 is still low at 46% as compared to the rest of the developed countries. China online sales are expected to grow at a compounded annual growth rate of about 27% to reach USD 618 billion in the year 2016. There is also a rising trend of B2C business segment in the e-commerce industry. This translates into ever more demand for high-quality logistics facilities that are located close enough to major markets to enable fast delivery. GLP has recently divested about 34% of GLP China business to a consortium of leading China domestic institutions and formed strategic partnership with China's state of enterprise. This development will secure long-term access to land, strengthen customer network in China, and foster better working relationship to enhance customer stickiness. We continue to like GLP for the following reasons. Number one, its market leadership position in China, Japan, and Brazil. Number two, visible portfolio growth from its asset recycling plan, and 3, its strong fundamentals. We maintain an accumulate rating with target price of 3.13. That is all we have for you today. Looking forward to Friday weekly market watch. Any question, any comments on Friday's topic? Please drop them via Facebook and Twitter. We want to hear from you. Thank you.